should be known that market volatility is a normal part of investing and is expected to be in any portfolio. Yet it can still be hard to sit back and be like, shouldn't I be doing anything? Every investor is different, but here are 7 things you can do during a volatile market. Hey guys, my name is Christian Mar and welcome back to my YouTube channel. On this channel I inform you about financial wellness. I also break down the news stories you need about the economy, your money, and your career. If this is your first time on my channel, guys, watching one of my videos, make sure you hit the subscribe button below, and if you're returning, welcome back. And I hope you find this video useful enough to share with someone. In this video, I want to talk to you about investing in a volatile market and what any investor should know about dealing with it. But first, what is market volatility? Market volatility is the frequency and magnitude of price movements up or down. The bigger and more frequent the price swings, the more volatile the market is said to be. And if you're following some of the swings recently, some of them were noticeable from the Silicon Valley Bank collapse and the fear of the banking sector. It should be known that market volatility is a normal part of investing and is expected to be in any portfolio. Yet it can still be hard to sit back and be like, shouldn't I be doing anything? Every investor is different, but here are 7 things you can do during a volatile market. Number 1. Resist the urge to sell based solely on recent market movements. Selling stocks when markets drop can make temporary losses permanent. History shows that stocks do recover and deliver long-term gains. Although I do have to disclaim, past performance is no guarantee of future results. My suggestion, take into account your investment's future prospects and the role it plays in your portfolio rather than being guided by noise and fear. 2. Keep perspective and take the long-term view. Downturns are normal, like I just said, and you're likely to experience several significant declines during a long investing career. But even bear markets, that is, periods when the markets fall more than 20%, historically have been relatively short compared to bull markets. And since market timing is nearly impossible, ignore the noise and stay focused to your plan. 3, and this is a very important one in my opinion, review your risk profile and your risk capacity. So your risk tolerance is your ability to emotionally handle big price swings, while risk capacity is your financial ability to take on a loss. Market downturns can be a wake-up call to reconsider your risk profile, but this should generally be considered at any time. 4. Make sure you have a diversified portfolio. I believe I've talked about this in one of my videos previously, but volatile markets tend to show you out if you thought you were appropriately diversified, but you really weren't. If you haven't looked at your portfolio recently to make sure you understand what each asset class is doing and that the mix matches your target allocation, now is a good time to become reacquainted with it. This goes hand in hand with your risk profile. 5. Consider including some more defensive or stable assets in your portfolio. Think of things like cash, treasury securities, and other U.S. government bonds. If you expect to spend from your portfolio in the next few years, it's a good idea to keep more liquid assets and less volatile than stocks, which should help to avoid selling some of your portfolio in a down market. 6. This is one I've mentioned before. Rebalance your portfolio as needed. Market changes can skew your allocation from its original target. Over time, assets have either gained in value and will account for more of your portfolio, while those that have declined in value will now account for less. Rebalancing means that you sell positions that have become overweight and move in proceeds to positions that have become less underweight. It's a good idea to do this at regular intervals. 7. Adapt your trading to fast-moving markets. If you plan to trade during volatile markets, watch out for the first and last hours of the trading session, which tend to be more volatile. Consider trading smaller positions or buying in increments as the price fluctuates. You can also try specific strategies during this time, such as stop orders and stop limit orders, which help protect an unrealized gain or limit potential losses. Strategies like this help make your decision more automatic and less reliant on doing the right thing when things get heated. Guys, companies are resilient. They tend to do a great job of working through situations like this when they arise. While it's tempting to give in to that fear, my encouragement, stay calm. With history as our guide, those who are patient and disciplined have done well with their portfolio. So guys, if you like the information in this video, please do me a favor, like, comment, and share with a friend, as it may help them as well. Don't forget to subscribe. See you next time.